Hello. My name's Ethan. Make sure to check out my website, ethanwrenn.com, for there you can find links to all my various socials. We are currently live on Twitch, YouTube, and the front page of my website. Make sure to follow and subscribe if you'd like to get notified when we go live next. What is it we're doing? Well, we're going to be looking at a video posted by the official TD Ameritrade account, and it's about how to use Bollinger Bands. This is an indicator you see me use in a lot of my videos, a lot of my trading. So let's learn a little bit more about it together.
Indicator that can help you define trends and measure the volatility of securities like stocks. In this video, we'll explain how Bollinger Bands are calculated and applied, and address the benefits and risks of using this indicator. The bands are calculated using standard deviation from a moving average. Standard deviation is a statistic used in probability theory and is commonly applied in financial markets to measure volatility. In financial markets, standard deviation measures the volatility of returns from a historical average or mean, such as a 20-day moving average.
Something to keep in mind when you're setting up your TradingView charts, for example, TradingView will kind of limit how many indicators you can have if you have like a free account, for example. So one way to get around this is the Bollinger Bands. The middle line is a 20 moving average. I have other videos on my channel that talk more about what moving averages are and which ones you should be using. You're going to want the 20 and the 180. So if you have a Bollinger Band indicator on your chart, then you already have a 20 moving average on your chart. Something to keep in mind.
Bollinger Bands are typically plotted 2 standard deviations above and below a moving average. This means about 95% of a security's historical price movement is likely contained within the 2 bands. This information can help you add context to trends and potentially determine when they might be overextended and reverse. Because the bands typically contain about 95% of a security's price movement, it's unusual but possible for the price to move outside the bands. But when it does, probability theory assumes the security price is likely to revert back to a moving average or mean.
I feel like Bollinger Bands is an indicator that's more beneficial to people on smaller time frames. Maybe you're an intraday trader using a 5-minute, a 15-minute, or maybe even an hourly chart. Once you get into bigger time frames, I feel like with Bollinger Bands don't really hold as much weight as they would on a smaller time frame. For example, if you're looking at a monthly chart or even maybe a weekly chart, I feel like the outer lines, the upper and lower bands, are very loose. Become very loose the bigger the time frame you're on. Again, this is an indicator suited for people on maybe smaller time frames like hourly and 15-minute charts, 5-minute charts, not really weekly or monthly charts, but it can provide valuable information. The same calculations being done, it is still showing you 2 standard deviations out regardless of time frame.
Between the upper and lower bands. This is called mean reversion, and some investors might use it to make trading decisions. Let's look at an example of how you may be able to identify entry and exit points using Bollinger Bands. A potential entry point can be set up when the price of a security falls below the lower band. Here, an investor might wait for the price to close back above the band before entering the trade. This is a form of confirmation when applying mean reversion strategies. A reversion to the mean is complete when the security rises back to its moving average. Some investors use this as an exit point. Others might target the upper band as an exit point.
And what he stated is absolutely correct. Right as the stock is touching that bottom Bollinger Band, this would typically be a sign that it's a good time to purchase. That's why if you're ever looking at like my charts, right? Whenever I'm setting up my indicators, for example, always use the default settings. So like if you're dragging in the RSI for the first time or the MACD for the first time or the Bollinger Bands for the first time, do not customize the settings at all. Leave them completely default. On my charts, the only things I'll change is I'll change the color of them. I use the night mode on TradingView, so I want something that's vibrant and that I can see, right? And I also want something that's kind of representative on how you might interpret the indicator. For example, I have the bottom band on my RSI and my Bollinger Band to be green, and I have the top band on my RSI and my Bollinger Band to be red. So when it touches the bottom Bollinger Band, like the IWM is doing currently, that's typically a buy, and then you would ride it up into the top Bollinger Band.
Others might target the upper band as an exit point, which is typically a bigger profit target and can take longer to achieve. Investors using the upper band as a target might look for confirmation by letting the price move above the upper band and then waiting for a close back below the band before exiting a trade. The idea is that a break back below the upper band is likely to revert to the moving average. Some investors look for additional confirmation by considering the slope of the bands. Put in simple terms, if the bands are
So this kind of goes into what I was mentioning a moment ago, right? So the bigger the time frame, the less useful I feel like Bollinger Bands become, because a behavior you will see so commonly among stocks is it'll be using the Bollinger Bands properly for a period of time where it's bouncing off the bottom, getting resisted at the top, bouncing off the bottom. But it's completely common and not uncommon for, let's say, there to be a bounce off the bottom Bollinger Band. It runs up to the top Bollinger Band and then proceeds to run way, like, you got to keep in mind when you're making this entry, right? You don't have this foresight of information that's happening here, right? So the Bollinger Band is going to be pointing to this level right here and your entry level, which is right here. You're going to be placing your trade and it's going to run all the way up to where that Bollinger Band was initially pointing. But it's not uncommon for the stock to continue running way higher than the initial level that the Bollinger Band was pointing at. Well, when you placed your trade, right? So if it was pointing here, the stock's now trading up here, that happens. And the same can be said on the other side, right? So if you were potentially using the Bollinger Bands for a short trade, you would have had a support here bouncing off the bottom, or this would be the midpoint, your 20 moving average, and this would be the top Bollinger Band. You go to place your trade, you're coming down, and when you're placing this trade, the bottom Bollinger Band's level is pointing right here. So you would have thought, okay, I enter the short, it's coming down, this is the level. And then in reality, the stock continues to just go way, 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 way lower than where the Bollinger Band was initially pointing. And that's, again, this happens on these bigger time frames quite often. You always have to, again, keep in mind your other indicators you're using, these other trends that are happening simultaneously that the Bollinger Bands might not account for that could cause this. And you also need to keep in mind the middle line of the Bollinger Band is your 20 moving average. So for example, here, when it crosses above that 20 moving average, well, what's the first thing we say that always happens? It comes down, as it did right here in this chart. It touches that 20 moving average, it acts as a support, bounces, and then proceeds to run. So it's quite common, as you can see in this chart, for a symbol to, trade between the middle, the 20 moving average, and either the top band or the Bollinger Band. So in a bullish state, you would expect to see a symbol trading between the 20 and the top band, and in a bearish state, you would expect to see the symbol trading between the 20 and the bottom band.
sloping up, then the security is in a potential uptrend. Conversely, if the bands are sloping down, then the security is in a potential downtrend. So, by referring to the slope, some investors might only take entry points in uptrends and ignore entry points in downtrends. Timing entry and exit points in these ways is one of the main benefits of applying Bollinger Bands. Additionally, the bands can help investors visualize statistical properties of securities and help identify when prices move unexpectedly 2 standard deviations away from a moving average. Keep in mind that these deviations can last for long periods of time, which is one of the biggest risks of using Bollinger Bands. Remember that probability theory assumes that security prices are mean reverting, but this assumption frequently breaks down in the real world. Here's a typical example of a security that has fallen to its lower band, or 2 standard deviations away from its moving average. Notice how the price continues falling along its lower band before eventually returning to the moving average. A mean reversion can take a long time, and during that time, the price of a security can continue falling. That's why investors typically avoid taking entry points every time a security falls below the lower band. Using Bollinger.
And again, this touches on exactly what I just said. You would typically be looking at a lot of other indicators, like maybe there's a price channel here, and this is the trend resistance, this is the trend support. And because you knew it was at the trend resistance based on the two priors that dictated that the resistance line was here, you wouldn't be looking for potential entries based on the Bollinger Band. And if this were to be like the trend support way down here based on two priors that led you to believe that the support line was here, this is where you might want to start employing the support aspects of the Bollinger Bands. Again, you got to make sure you're using a variety of different indicators in conjunction with each other and not just relying on any one sole piece of information.
Bollinger Bands as a standalone indicator is risky. For a more balanced approach, an investor might consider using Bollinger Bands to add context to trends and help time entry and exit points that arise from other forms of analysis, such as fundamentals and the market's overall trend.
I honestly think these videos being put out by TD Ameritrade are really great. They've been out for a long time. I don't know if they still do them, but they present the information quick, concise, clearly, easy to understand. And for new investors, it can really help them understand why technical traders trade the way they do, look at the indicators they do, and see value in these different types of patterns that we're so used to seeing on this channel.